It's sometimes said that a poor financial planner is a poor financial planner. The economic impact of the COVID-19 pandemic has been tough for businesses up and down the country, including many financial planning businesses. According to a new survey from the Financial Conduct Authority, around 4,000 businesses in the retail investment sector, that includes financial advisors, face a significant risk of failure this year. What's more, nearly a third of those businesses could cause consumer harm if they collapse. In this video, what's putting financial firms at risk in 2021 and the questions that you need to ask of your financial advisor to make sure that they'll still be in business at the end of this year. Hi everyone, I'm Bamford, a chartered financial planner at Informed Choice. On this channel, I talk about personal finance, investing and happiness. I make these videos to help you become wealthier and happier. If that sounds like a great result, click on that little red subscribe button to become part of our subscriber community. It's completely free and you'll never miss an episode. According to the Financial Conduct Authority, the COVID crisis has put around 4,000 investment businesses at heightened risk of failure this year. The regulator sent out a survey to almost 23,000 regulated businesses to understand their financial resilience levels during the pandemic, concluding that the pandemic may cause significant numbers of firms to fail over the next 12 months. Financial firms at risk of collapse in 2021 include insurance intermediaries and brokers, payments and electronic money firms, and investment management companies. According to the FCA, these businesses experienced the most significant fall in cash and assets during the pandemic. And without those levels of cash and assets, the businesses are at greater risk of collapse. Sheldon Mills, who is the FCA's Executive Director in charge of Consumers and Competition, said the situation was unprecedented and rapidly evolving, saying a market downturn driven by the pandemic risks significant numbers of firms failing. At the end of October, we've identified there are 4,000 financial services firms with low financial resilience and at heightened risk of failure, though many will be able to bolster their resilience as and when economic conditions improve. He added, these are predominantly small and medium-sized firms, and approximately 30% have the potential to cause harm in failure. In line with businesses across the country, almost 60% of the regulated firms surveyed by the FCA said they expected their income to drop because of the pandemic. Nearly 700 of the regulated firms thought their income would fall by more than 2/3. Now that's a serious drop in income for a regulated business because it's likely to have a lot of fixed costs to cover. That means their income could fall quite significantly, but they're still having to pay out the same amount each and every month. Now, clearly the FCA is worried more about the impacts of these businesses failing than about the businesses failing themselves. When publishing the survey data, they said that disorderly failures could hurt consumers by reducing competition in the sector and harming the effectiveness of markets and overall confidence in the UK's financial system. Last year, we completed 2 of these financial resilience surveys from the FCA. That was in addition to our usual twice-yearly regulatory data returns, which include details of our financial adequacy. When the FCA published data from its first survey, which was carried out pretty early on in the pandemic, they were talking about hundreds of financial services businesses at risk of collapse. To be talking this time about almost 4,000 businesses is a big step up. From our perspective at Informed Choice, the findings in this survey are not a concern for our business, for our staff, for our clients. We are in great shape financially with no debts, we've got healthy capital reserves in the bank, and we're a business that's been consistently profitable every single year since we started back in 1994. In fact, 2020 was another record year for us in terms of turnover and profits, and we exceeded our expectations about new client acquisition. But I recognise that things are tough for many of our peers, and this FCA survey confirms that. We also see regular updates from a data research firm called Plimsoll, which carries out analysis of companies' house data and accounting data to understand the financial strength of the sector, and it's rarely happy reading. There's always a decent proportion of firms that are not doing particularly well in financial terms. As a client of a financial advisor, you need to do your due diligence. That includes understanding their financial strength. Ask them for a copy of their unabbreviated company accounts. The company accounts that most financial advisors submit to Companies House, the ones that you can view for free online. These are abbreviated because of the smaller companies exemption. But your financial advisor should not have anything to hide, and they should be willing to send you their latest full and unabbreviated accounts. With those accounts in hand, look at their net profit for the past couple of years. That should be a positive figure. Look at their retained profits. Make sure there are some, that they're keeping some profits each year in the business. Check for any debts or any liabilities which are not covered by their assets. Compare their annual profits to the dividends which are being withdrawn by the shareholders. You want to make sure that they're not extracting every last penny from the business, but instead reinvesting for the future and building some capital reserves for tougher times like right now. If you're a client of a regulated financial advisor in the UK, you can take some comfort that regulatory requirements offer a degree of financial security. Regulated firms have to maintain a minimum level of capital adequacy, typically cash in the bank, and they have to report that to the FCA twice a year, but also immediately if they breach that minimum requirement. Regulated firms also have to maintain professional indemnity insurance, PI insurance, backing up their advice, although often these policies will cease to cover the advisor and therefore their client in the event that the company goes bust. I started this video by saying that a poor financial planner is a poor financial planner. When looking for the right advisor for you, there is nothing wrong with getting personal, asking them some searching questions about their personal financial position. How much debt do they have? What assets do they own? What's their net worth? Probably most importantly, do they have their own financial plan in place? And what progress are they making towards the goals in that plan? If these FCA survey findings materialise in 2021, there are going to be fewer financial advisors in business at the end of this year. There's already far too few to go around, and demand for financial advice for financial planning is consistently rising as more and more of the wealthy post-war baby boomer generation reach retirement age, often with quite complex financial advice needs. As well as it becoming harder in the future to find a financial planner with capacity to advise you, another consequence of reduced supply is, I'm sorry to say, higher cost of advice. That's at a time when the regulator and various commentators are suggesting that we charge less for what we do. But basic economics tells us that a market with falling supply and rising demand, prices will go up. Another reason the cost of financial advice will head up as more firms fail is to cover the higher cost of regulatory expenses and also the levies paid to a financial services compensation scheme to compensate the clients of failed businesses. It's a vicious cycle. When was the last time you looked at the books of your financial advisor? Are they at risk of collapse in 2021? Let me know in the comments. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.